Hello and welcome back to The Note. We saw the non-resolution of one long-running story this week. A shares are still not part of the main emerging markets indices, and I suspect we'll see the non-resolution of two other very important long-running stories next week. Just bear in mind that in all cases there will be a resolution at some point. Next week, on Wednesday, we have the FOMC meeting from the Federal Reserve. At one point, this was apparently the meeting at which we really were going to see interest rates rise at last. That's not going to happen, barring a quite remarkable rush of blood to the head at the Fed, but we could get a lot more guidance on whether we really can expect it in September. Certainly the chances that the rates could be going up as early as September do seem to have risen on balance since the last meeting. The data has been that much stronger. The day after, on Thursday, European finance ministers meet. That could be the moment when push finally comes to shove over Greece. The negotiations have been interminable. They seem to have been going on rather longer than the Iliad or the Odyssey did, but we do seem to be coming to some kind of a conclusion because the money is going to run out at some point. My best guess, and this is in line with what the market is betting, is that we're still not going to get a resolution next week, and that ultimately by the end of this month we will have yet another very unsatisfactory deal which kicks the can further down the road. That's in line with the somewhat negative results we're seeing in markets in Europe, certainly not reflecting a strong chance of a true Grexit nightmare scenario. If markets were discounting that, they would be very much lower than they are. Again, though, just bear in mind, at some point the Fed really is going to have to raise rates, and at some point the Greek situation will have to be resolved. Now, I'd briefly like to talk about the big story from this week, which was the issue of whether to include A-shares, Chinese A-shares, in the MSCI Emerging Markets Index. As you can see from this chart, the leadership of emerging markets has changed frequently over the last 20 years, but you've never had any one country with more than about a quarter of the total index. If you take a look at the allocation now, obviously China has risen to that level, even though A shares, the shares that are available virtually only to domestic investors, are not included at all. This gives you an idea of what proportion of the index China would take if A shares were included at their full market capitalization. Plainly, it would be like a very big whale jumping into the water. It's questionable, even realistically, how useful emerging markets as an asset class would be. Remember, it's only really came into being back in the 1980s when the World Bank wanted to rebrand the third world. People didn't want to invest in third world countries, they did want to invest in emerging markets. Now, MSCI, the largest indexer, considered including A-shares in its main index this week and decided against it because the A-share market had not opened up enough. It obviously came under very heavy lobbying from fund managers not to include A-shares. If there is a reason for that, you can probably see it here. There has been an extraordinary ramp up in both Shanghai and Shenzhen over the last year. Effectively, the only place to make money in equities over the last 12 months has been in the Chinese domestic stock market. Very many international investors haven't believed the Chinese story, with good reason. The Chinese economy is slowing down. There are many reasons for concern about China. Suddenly beginning to judge them against this benchmark would be very embarrassing for them. It would also involve attracting a big flow of money into that market when it already looks very toppy. Now, when you might ask, why does it really matter so much whether MSCI includes these things in an index? Well, $1.7 trillion is indexed against the MSCI Emerging Markets Index. That's not just tracker funds, passive funds. If you're an active manager but your public benchmark is the MSCI and the MSCI makes a big shift, you really do have to try to match it to some extent, or your performance will look that much worse. If you want an idea of the effect this can have, the UAE joined the index a year ago, having been under consultation to do so for 2 years before that. As you can see, once it became known that MSCI was considering letting the UAE in, it led to a quite extraordinary ramp up in the share price, which was not replicated across the rest of emerging markets. China is much bigger. You wouldn't have seen that kind of an effect, but you would have seen, and at one point will see, because it does look inevitable that A shares will join China at some point, will join the index at some point. You will see huge inflows of money into China at some point when this index change happens. That's why it matters, and that's also why, given that China still hasn't opened up enough, it didn't happen this week. You never know, we might see a denouement of an important story next week.